Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that it's up. Now, if you're not on my free stock trading email list, go below this video in the description. There's a link to join it. Hope you had a good Thanksgiving, and I want to talk about some of the trends happening in the market and what's happened with this crypto exchange, FTX, and what we can learn from that. Because it has a lesson for everyone, even if you didn't lose money in it. But the good news about the markets is we have been having a rally in the S&P 500 in the past couple of weeks. And the action in the bond market so far is confirming that rally. Now, that might change in the coming weeks, but it's not changing now. So I don't think we have to worry that a significant top is coming in the market this week, a huge decline. Although historically, over the past 100 years, the week of Thanksgiving, more than any other week, sees the stock market have an up week. And then there's a little bit of a pause or breather in the week afterwards. So I don't really expect a whole lot to take place this week. That said, let me show you specifically what I mean when I say that the bond market is confirming the rally. So what you're looking at here is a chart of the S&P 500 of all these lines and circles I've drawn on it. And what do they mean? Well, the top chart is the S&P 500, and it's fallen this year, obviously, and it still remains below the 200-day moving average. So the big picture is we have been in a bear market this year. Now, we have seen really three big counter trend rallies within that bear market. The primary trend down, the counter trends, short-term trends. In March, the S&P 500 went from 4,200 to roughly 4,600. That's that first upline I've drawn. In June and July, something of a bottom was made that launched a rally up into August that stalled out at the 200-day moving average. Now, we're currently still in a rally, began in October, and we're right below the 200-day moving average. If this rally continues in December, and I think it will, we will go through that level. We will see the S&P 500 go through that level. Now, on the bottom of this chart is the TLT exchange traded fund. That is an ETF that tracks the price of the 20-year treasury bond. It is a bond ETF, one of the biggest bond ETF for treasury bonds that trades. More money in it than any other. And that's been in a bear market too. In fact, that exchange traded fund peaked out months before the S&P 500 did. It began a bear market months before the S&P 500 did. It has been leading the market down. In other words, it has peaked before the S&P 500 has peaked multiple times. And that's what I want to point out to you on this chart. So in March and April, while the stock market went up, this ETF went down. It did not confirm that rally. In June and July, though, when the S&P 500 was making a bottom, this ETF went up. And that's the period of time I've circled on the chart S&P 500 on the top and the TLT ETF below. Confirmation. TLT confirmed the potential bottom in the S&P 500. And then that rally continued more than the rally in March, which really didn't even last a month. But that rally lasted, if you count from June to the end of August, over 2 months, over 8 weeks. But it ended. And the thing is, the TLT peaked out at the beginning of August, while the S&P 500 continued higher for a rough 2.5 weeks. So TLT warned in August, hey, this rally is coming to an end. Be very careful. And anyone who took that seriously, taking money off the table, did the right thing. Or even betting against the stock market or putting on hedges could have actually profited when the market turned down, which is what it did. And it fell and made new lows because it was still a bear market. So what is happening now? Just like in June and July, the action in TLT is confirming the action in the S&P 500. That's good. What that means is right now, there's no reason to be overly alarmed about the short-term trend in the stock market, even if it takes a breather this week. Now, if at some point before the end of this year or next year in January or February, TLT starts to go down while the stock market can just go sideways or goes up, that would be a serious warning sign to take some more money off the table and not, and just to completely ignore and dismiss all the bullish talk. Because every time the market does go up at all the bulls come out and tell you it's going to go up, it's going to go up, everything is going back to the way it was in 2020, inflation's going to go away, interest rates are going to zero. They said that in June and July, they said that in March, they're saying it again, they'll continue to say it, more and more will come out and say it, and they will be wrong. Because the macro environment is not changing, but we're in a short-term rally, and there's no reason to think that's over. What my objective in these markets to do is not to predict the future, but to identify the current trends in the market and when they change, and that means being apprised of the most important indicators that can indicate when such a change is happening. And I have just presented to you in the past couple of minutes what you need to keep your eye on now to see to know when this current rally is really in danger, and it's not right now. So what else am I watching? The U.S. dollar index. The U.S. dollar index put on a big rally this year that ended just a few weeks ago. It ended when you can see it, the 50-day moving average, the blue line on this chart, had been acting as support until the U.S. dollar index smashed through 109, and now it's trading between 108 and 105. 105, the 200-day moving average. Now, why is this important? Because one thing about the global inflationary trend is that inflation, while it's been high in the United States, it's been higher in Europe by almost 2%. And the reason why is because the U.S. dollar index went up. That made it so that when the U.S. imports oil and energy and any other goods, it's cheaper than it's been in other countries. Now that the U.S. dollar index rally has ended, that situation is going to slowly come to an end, and it'll be different 6 months from now. We're not going to get the help of the U.S. dollar index rally. Why is that happening? Because the Federal Reserve was raising interest rates at 3/4 of a point multiple times at a faster rate than Europe, England, Japan, other countries. And now that the Fed is going to 50 points instead of 75, it's slowing the size of the rate hikes while other countries are increasing theirs. So that is a huge macro difference that impacts currencies. That's what's causing U.S. dollar index to trade the way it is. It's also fueled some money starting to flow into gold and precious metals. We've seen them pop back up. As I've said in the past couple of weeks, silver busted through $21 an ounce, and that I've put more money to work in mining stocks and precious metals as a result of these shifts that have taken place. I took a lot of money off the table in June and put it back on, basically. And to give you an idea what's going on, here is wheat and precious metals. This is a big cap silver mining stock that I own. I bought it a couple weeks ago, or bought it back a couple weeks ago, I should say. And it popped back up. It hit 38, came down, formed an ascending triangle pattern, and is busted out of that pattern over the past couple of days. If you look through, many mining stocks have a similar pattern. So these are the type of patterns I'm looking to trade now in these markets. What about crypto? Now, the FTX thing, it's a disaster. It's a debacle. And people out, the gurus, the crypto gurus are saying, ignore it, put money in Bitcoin. Bitcoin's fine. This is just a problem with FTX. No, they're wrong, because if you're serious about making money in the markets, the number one thing you need to do is buy and invest and trade, get involved in things that are beating the performance of the S&P 500. If you want to beat the markets, you need to be in the things beating the markets. If you do the things that do the opposite, that lag when the stock market rallies, are prone to crashes when stock market rallies come to an end and can just crash anyway. And that's been the situation for Bitcoin for a year and a half. So that fact that Bitcoin had been lagging the market meant it's a vulnerable thing. It's a millstone for people's portfolios, and it's still a millstone. It's still lagging the S&P 500. And what's it going to likely do? Sit here around 16.5, maybe 17.5, just sit here for a couple weeks, and then fall again. That's the most likely thing it's going to do. Why? Well, it's done it multiple times. In June, look at the chart. Bitcoin fell to roughly 33,000 in January. Then it tried to rally. It got back up to 47,000 in April. Then it came back down. And then when it broke that January low, it smashed. It fell below 27,000. Then there was another bounce attempt, and it fell below 27,000. Then smash. By June, it was below 20. And then it tried to bounce again with 19,000 or so as the new support level. What happened? It smashed again in November, and now support is like 16,000. So here we are. What does it do? Stair step down, and it's going to stair step down again and make people involved in it lose money. That's the chart set up. It's a horrible bear market. It's the worst thing people can put their money in. And here's the thing. We're not in 2020 anymore. And you have to think about what is it you want to buy. Okay, trading is one thing. If you're just day trading, you are doing prices, pure price speculation on a short-term basis, and anything can go up and down. The shorter the time frame, the less the fundamentals of what you are trading or trying to hold matters, and the closer you get to pure gambling. And that is what crypto is. Because crypto is nothing what the gurus told you it is. They told you it's money, and it's not. You see, what is money? Money is a store of value and a medium of exchange. Crypto is neither. Everyone that's bought it and tried to trade it, it's a pure speculation. And you see what happens to the inherent risk in that is high. And you see what the result of devastation for the people that put everything they own into it. They put their net worth into something that has no intrinsic value, and it is a nightmare world what these exchanges are and the people behind them, and they got fleeced. And I would suggest the lesson to take from that is to do the opposite, to get involved in things that have a solid basis in real world companies, that stocks of companies that have real earnings, real earnings growth, that have the ability to pay dividends, and the stocks, when you buy them, are at cheap valuations. That's how you invest in the stock market. That's how you make it so that the trades that you do have the maximum payoff. You focus on the entry point of the quality of what you're getting into and seek good situations. You have a choice to buy. If you're trading anything, there's thousands of things you can buy, from cryptocurrencies to penny stocks to regular stocks, exchange traded funds. Why not pick out the best situations instead of the worst? That's the way to really handle the markets. So combine focusing on trying to make price gains with the type of high quality thinking the best investors have. Combined all of the best worlds is the way to most get ahead. But the simplest thing is to focus on this. Buy and trade, get involved with those things beating the market, and then you can beat the market, and that compounds your wins over time and builds true success, instead of flash in the pan situations that burn you when you touch them. And that's what FTX shows that the crypto market is. So those are my thoughts today. This is the first time you've seen me on YouTube. Hit the subscribe button, hit the bell next to it. YouTube will send you the next video update as soon as it's up, and hit like on this video. It helps get the word out of what I'm doing too. And I'll be talking with you later.